Hi, this is Jeffrey Kerr at Kerr Financial Group, and today we look at the markets and the economy from the perspective of whether the glass is half full or is the glass half empty. Given what the markets have gone through the last few weeks, let's put some champagne in the glass as things have really been recovered nicely, and I think the story behind that is the kind of the key part of the debate. The markets have had a very nice third quarter after having one of the worst first 6 months of any year. Right now, into the from July 1 to third quarter, the S&P 500 is up 11.7%, and the Nasdaq is up almost 15%. But year to date, both indexes and all the major indexes are still down. The S&P is down year to date, down 7%, but still a nice recovery. Nasdaq still down 19% year to date, and even more from its November high. But a nice recovery in July and August so far. And the narrative and the bulls' thesis is that the inflation has peaked. It's going to start coming down. Interest rates have peaked. Going to start coming down. The economy is going to recover. The Fed's going to stop raising interest rates, and it's all unicorns and rainbows from here. So I think some of those things we'll get into. But let's looking at the inflation has peaked. A lot of commodities have come off. Now that's I think a double-edged sword that in the sense that yes, commodities are declining, but it's also maybe a function of demand destruction. For example, crude down 1.4% last week, down 27% from the peak. Copper, lumber, corn, all down, in the last 3 months. And the CRB index is down 7% in the last 3 months. So that will help bring inflation down. However, there are many other factors in that inflation equation. I'll return to some thoughts on that later on. The Fed pivot. The bulls are counting on the Fed to stop raising interest rates. I think that is kind of dangerous. The Fed has said in September they're going to raise 50 basis points. They've already broadcast that and guided that. I just don't see them. The Fed doesn't pull surprises on the market. They are, they telecast, they tell you what they're going to do, and then they do it. And the July meeting and the July rally in the markets partially predicated on the Fed doing a 75 basis point hike in July and then kind of guiding the September meeting to only 50 basis points that the market had worried about 75. So 50 basis points September, 25 in November, and a possible another 25 after that. So, I guess you could say, well, we're going to pivot soon, but I'm not so sure that the rally, recent rally is really fully supported by the Fed pivot, theme. I think that with regard to inflation, that there are some other systemic type issues in there in terms of wage inflation and job openings not being able to be filled, maybe a mismatch of labor talent and job demand, and that there's going to be further type wage pressure, which could keep inflation high. And I think natural gas has not come down. That's a key component. Big news recently about the European markets buying as much liquefied natural gas that could keep our natural gas prices elevated here in the U.S., which natural gas not only for heating and cooling but goes into a lot of the industrial process as well. So those things I think there while commodities could come down, and again that may be a function of demand destruction, which is not good for economic growth. That there are other factors that could, also pressure keep, inflation elevated. And, just that inflation coming from 9.1 down to 8% is, yes, it is declining, but it's still going to be a big obstacle for the economy. And a couple of nuggets here I want to pass along concerning interest rates and recessions. So I'm pulling these from Hedgeye Research, and specifically Josh Steiner had written about these. One of the analysts there, that since 1946 there have been 12 recessions. 8 of those 12 are after a major spike in the price of crude oil. And then 3 other ones are after price run-ups in crude oil. And only one didn't have, the oil spilled on it. So 11 of the 12, we, had significant increase in crude oil. It's backed off some. I don't know how much more it could back off. I think it's a mismatch of demand and supply, and we'll see. But it would seem to me that there's further to go in economic decline. Another nugget is that there's been 9 episodes since World War II of increasing interest rates, Fed hiking interest rates. And the interesting thing coming out of it is that the trough of the asset prices only 3 times were near when the Fed stopped hiking interest rates. And 6 of those troughs in asset prices, stock prices, bond prices, bond yields, and like that, were an average of 21 months after the last Fed hike. The minimum was 10 months, and the maximum was 41 months. So kind of applying this to, not to say that it can be different this time, but applying this to, if the Fed is going to be hiking into the end of the year, beginning of 2023, 6 times in history, the shortest period before asset prices troughed, found a bottom, was 10 months later. And that's the minimum. The average is 21 months, almost 2 more years. And I think, again, the dynamics of the economy are, we are going to see, the corporate guidance for earnings and like that has not been great. Layoffs are starting and like that. So I think that this bull narrative, glass half full, hey, I want to be an optimistic and find reasons for growth in the future, but I still also try to be realistic that there are some real challenges in front of us. So I think it's still, from a investment standpoint, still time to be defensive and cautious, and even take advantage of this run-up back in the stock prices and the recovery, because I think there's still some headwinds and some challenges ahead of us. And if I'm wrong, and if the bulls are right, and that there's a Fed pivot and all these things kind of fall in line, there's still opportunity to get back in. I don't see it happening soon, but there could be, and I'll try to keep you posted as what I see. Please let me know if I can help in any way, and also keep sending suggestions and comments to us too. Thank you so much. Goodbye.